The queue outside the Beirut Bank began forming before sunrise, stretching past shuttered shops and cracked sidewalks. Not because money was arriving, but because access was disappearing. People who had once trusted monthly statements were arguing with security guards over limits that had changed overnight. Inside, screens still displayed balances in neat columns, yet those numbers no longer described anything that could be fully withdrawn. What remained was an accounting memory of purchasing power that had already started dissolving. Scenes like this are often treated as distant anomalies, products of political mismanagement or regional instability. That framing avoids an uncomfortable implication. Similar mechanisms operate quietly inside stable systems only at lower speeds. In the present environment, no lines form outside most banks, and cards still swipe without resistance. Yet the arithmetic running beneath those transactions increasingly points in the same direction, only stretched across decades instead of weeks, measured against housing, healthcare, insurance, and education. The currency in many advanced economies now loses around 7% of its effective capacity each year. That number does not appear on statements, which is precisely why it rarely triggers institutional alarms. At first glance, this erosion looks like ordinary inflation, a technical adjustment managed by central banks and statisticians. That explanation, however, treats purchasing power as a surface phenomenon rather than a structural outcome. The analysis that follows will not argue that collapse is imminent, nor that escape is simple. Instead, it will examine how value migrates through systems over time and why some forms of wealth endure erosion better than others. Before moving forward, one assumption needs to be questioned. Loss is often imagined as a sudden event, when in most monetary systems, it unfolds as a slow redistribution of claims. To track that redistribution, a simple framework will be used throughout this investigation. Money as a layered contract between individuals, institutions, and future production. Each layer absorbs stress differently, and none is permanently insulated. At the base of this structure sits real output, the goods and services an economy can physically deliver. Above it rest promises, wages, bonds, deposits, and pensions, all competing for slices of that output. When production expands faster than claims, purchasing power stabilizes. When claims grow faster than output, dilution becomes mathematically unavoidable, even if no crisis is visible. This pattern appeared with particular clarity in post-war Britain, where decades of moderate inflation quietly reduced the real value of government debt and private savings without dramatic episodes. The public narrative focused on growth, while the balance sheets told a slower story of erosion. A similar dynamic is now observable across many developed economies, where asset prices inflate while median incomes lag, creating the impression of prosperity alongside declining affordability. The mechanism does not require mismanagement, only persistent imbalance. Still, this framework has limits. Not all dilution is harmful, and some redistribution can stabilize fragile systems, at least temporarily. Recognizing that boundary matters, because without it, every instance of inflation appears identical. In practice, different layers absorb pressure at different moments, producing uneven losses that are often mistaken for personal failure. This channel approaches these patterns as financial forensics, studying past system failures to understand what survives. The goal is not prediction, but reconstruction of incentive structures after stress has already been applied. From that perspective, the Beirut Q was not simply a story about corruption or capital controls. It was a compressed illustration of what happens when layered promises converge on a constrained base. The question, then, is not whether money loses value over time, because history suggests it usually does. The question is how that loss is distributed, delayed, disguised, and sometimes redirected. That distinction will guide the next stage of this investigation, where slow erosion replaces sudden collapse as the primary object of analysis. What remains unresolved is who absorbs that erosion first, and why it rarely looks like a crisis while it is happening. In most systems, erosion does not begin where it is most visible. Instead, it starts where resistance is lowest, often among fixed claims that cannot renegotiate their terms. Consider post-1970s United States pensions, many of which were structured around fixed nominal payouts. As inflation accelerated, retirees discovered that contractual certainty did not guarantee material stability, even though no default had occurred. The underlying mechanism was straightforward but rarely acknowledged. When prices rise faster than indexed benefits, real purchasing power transfers from beneficiaries to issuers without any formal restructuring. A modern parallel appears in long-term savings accounts yielding below inflation, where balances grow numerically while their capacity to secure housing, care, or education declines. The loss is distributed invisibly through arithmetic rather than policy. Yet this process is not uniform. Some fixed claims are politically protected or partially indexed, complicating any simple hierarchy of vulnerability. Housing provides a second layer in this sequence. In Weimar Germany, property owners with mortgages saw their debts evaporate during hyperinflation. While renters faced rapidly escalating costs, what mattered was not ownership alone, but the structure of obligations attached to it. Assets encumbered by fixed liabilities benefited from currency dilution, while unleveraged positions did not. Today's parallel can be observed in heavily indebted real estate markets, where inflation reduces the real burden of long-term loans, even as nominal prices rise. The apparent wealth effect masks a quieter redistribution between borrowers and lenders. Still, leverage cuts both ways. When credit conditions tighten faster than prices adjust, the same structures amplify losses rather than protect against them. This duality introduces an important complication. Inflation does not reward assets automatically. It rewards specific balance sheet configurations within particular policy environments. Corporate equity illustrates this conditionality. During the inflationary 1970s, many publicly traded firms underperformed despite rising revenues because input costs and wage pressures eroded margins. The mechanism here was margin compression combined with capital misallocation. Firms that could not pass costs to consumers effectively became conduits for inflation rather than shelters from it. In recent decades, large platform companies have often escaped this trap through pricing power and global scale, allowing earnings to track or exceed monetary expansion. Their shares appear resilient, but only within that narrow structural niche. Even so, technological shifts and regulatory interventions periodically disrupt these advantages. Pricing power is neither permanent nor evenly distributed. At this point, it becomes tempting to search for a universal refuge, some category of ownership immune to dilution. History offers little support for that expectation. Gold, for instance, preserved value during parts of the 1970s, but stagnated for long stretches thereafter, imposing opportunity costs that were themselves a form of erosion. Its performance depended on monetary credibility as much as scarcity. The same conditionality applies to foreign currencies. During Argentina's recurrent crises, holding dollars protected savings temporarily until capital controls and forced conversions altered the terms of ownership. Here, the mechanism was jurisdictional risk layered onto monetary risk. Legal authority, not just supply, determined whether purchasing power remained accessible. This introduces a boundary that is often overlooked. Assets do not exist in isolation from enforcement systems, and those systems shift under pressure. What consistently fails first, across these cases, is not a specific instrument, but rigid promises detached from adaptive revenue. Fixed returns, guaranteed payouts, and static benefit formulas absorb dilution before flexible claims do. Yet, even this pattern is incomplete. Some rigid promises are sustained through taxation or monetary expansion, transferring losses elsewhere rather than eliminating them. Current global conditions reflect this complexity. Aging populations, high sovereign debt, and productivity plateaus constrain real output, while political incentives favor continued expansion of nominal claims. Central banks attempt to manage this tension through interest rate adjustments and balance sheet operations. These tools influence timing and distribution, but they do not resolve underlying imbalances. Recent episodes of rapid price increases followed by partial disinflation illustrate this point. Temporary stabilization alters trajectories without resetting structural ratios. Under the layered contract framework, such periods resemble pressure redistribution rather than relief. Stress migrates between sectors, generations, and asset classes. One limitation must be acknowledged here. Data aggregation often obscures micro-level resilience, and individual outcomes vary widely within systemic trends. Still, the directional tendency remains observable. Systems with expanding claims and constrained output channel losses toward the least adaptable layers first. The investigation now turns toward how individuals and institutions interpret these signals, and why many misread slow erosion as personal miscalculation, that misinterpretation itself becomes a reinforcing mechanism. For most participants inside these systems, erosion is interpreted through personal narratives rather than structural ones. When savings underperform, the explanation defaults to poor timing, insufficient discipline, or flawed strategy. During Japan's post-bubble stagnation, households continued depositing into low-yield accounts for decades, even as real returns remained negative. The habit persisted because nominal stability felt safer than unfamiliar alternatives. The mechanism was psychological reinforcement, combined with institutional design. Banks, employers, and regulators maintained frameworks that rewarded compliance over adaptation. A similar pattern appears today in automatic enrollment retirement plans that funnel contributions into standardized portfolios. Participation increases, yet exposure to long-term dilution often remains unexamined. This does not imply irrationality. Faced with complexity, most individuals choose predictable losses over uncertain adjustments. However, predictability itself becomes a channel for redistribution. When millions follow identical default paths, systemic pressures concentrate rather than dissipate. Public debt markets offer a parallel. After World War II, many governments relied on financial repression, keeping interest rates below inflation to gradually liquidate debt. Savers bore the cost without formal negotiation. The underlying process involved regulatory constraints combined with moral suasion, limiting alternatives for large pools of capital. Yield suppression became a policy tool rather than a side effect. In contemporary markets, similar dynamics emerge through capital requirements and benchmark-driven investment. Institutions remain structurally aligned with low real returns. Still, this arrangement is not permanent. As pressures accumulate, behavioral patterns begin to shift, often unevenly and belatedly. The first signs usually appear at the margins. Informal economies expand, alternative payment systems gain traction, and contractual arrangements shorten in duration. Venezuela in the 2010s provides a compressed example where dollarization and barter re-emerged alongside official currency. Formal systems persisted, but parallel ones absorbed functional demand. In advanced economies, the shift is subtler. Contract terms shorten, variable pricing becomes standard, and risk is quietly transferred to households. Subscription models, adjustable rate services, and performance-linked compensation reflect this adaptation. Flexibility replaces certainty, but stability does not necessarily improve. Here, the framework requires refinement. Adaptability reduces exposure to fixed dilution, yet it increases exposure to volatility and bargaining asymmetry. Not every participant can negotiate effectively. Power differentials shape who benefits from flexibility and who absorbs its risks. This leads back to the central question: how do some claims retain relative purchasing power while others steadily erode? The answer does not lie in asset categories alone, but in positioning within production and enforcement networks. Claims anchored to scalable output and protected by credible institutions adjust more easily. Yet even those anchors shift. Technology alters production, demographics alter demand, and political coalitions alter enforcement priorities. Recent global signals reflect this instability. Supply chain reconfiguration, labor shortages, and fiscal expansion interact in ways that resist simple forecasting. Under the layered contract model, these signals indicate increasing friction between promised claims and deliverable output. Adjustment remains ongoing rather than resolved. Importantly, adjustment does not require crisis. It can proceed through decades of marginal recalibration, with no single moment marking failure. This gradualism complicates interpretation. Without clear breaks, participants underestimate cumulative effects. Practical synthesis, at this stage, does not involve selecting instruments or strategies. It involves understanding that purchasing power is a negotiated outcome inside evolving systems. What survives longest tends to be what can renegotiate continuously, embed itself in productive processes, and remain legible to legal authority. Even that description is incomplete. Negotiation itself depends on timing, leverage, and institutional memory. The Beirut Q returns here not as spectacle, but as endpoint. Those depositors encountered in days what others experience over lifetimes. Their balances had been layered promises resting on constrained output and eroding credibility. When adjustment finally concentrated, it appeared sudden. Seen through this framework, the 7% annual loss is not a mystery or an anomaly. It is the visible residue of continuous redistribution. Whether it remains slow or accelerates depends less on forecasts than on how layers continue absorbing pressure. That process, already underway, does not announce itself.